Good evening, students. Welcome to the session. So, today we are going to finish off our last topic that was somewhat remaining, and then we'll proceed with the next topic, which is the exempt income or the income not chargeable to tax, right? So, that's the second topic that we are supposed to do it today. But first, we'll finish off the first topic. So, let's just first quickly revise what we have done in the last class. So we were discussing about the tax rates, right? For the individuals and for the cooperative society firm, we have done it, right? So first for the individual, quickly tell me what are the tax rates under the old regime? Yes, let's just quickly revise.
Under old regime, up to 2.5 lakhs, nil rate of tax, 2.5 to 5, it is 5%, 5 to 10, 20%, above 20, 30%. And for resident individual, senior citizen greater than 60 years and less than 80 years, uh, up to 3 lakhs nil, 3 to 5, 5%, and then it comes 20% and 30%. Then again for a resident individual, super senior citizen greater than 80 years, up to 5 lakhs nil rate, and then 20%, 30% under old
Correct.
regime.
Very good. And when do we see if a person is, let's say, for example, becoming this or reaching the age of 60 years or 80 years on 1st of April? So then do we give the benefit for the last year?
Yes, we will give the benefit for the last year. It is
Yes.
circular has been changed for that. That's the
Yes,
benefit.
in accordance with the CBDT circular, right? We'll give the benefit to the assessee, right? If he's becoming 60 or 80 as on 1st April, isn't it? Yes. Now, what about the rebate under the old regime? What is the rebate which is allowed under 87A?
Rebate under 8700, maximum up to 12,500 or tax amount, whichever is lower.
Correct. Very good. And then, what is the surcharge under the old regime?
Greater than or equal to 50 lakhs to 1 crore, it is 10%. Greater than 1 crore and less than or equal to 2 crores, it is 15%. From 2 crores to 5 crores, it is 25%. For first two, it is total income, including dividends and STCG for 1111A, long-term capital gains 112 and 112A. And for the third one, greater than 2 crores and less than or equal to 5 crores, it is total income excluding the dividends, short term and long term. Then it is
Correct.
25%, and greater than 5 crores, it is 37%. And dividend, short term and long term, it will be capped to 15%.
Correct. Very good. So that is about the old regime, right? So the highest rate of surcharge under the old regime is 37%. However, if you have the dividend LTCG, STCG, which is chargeable under 111A, 112 or 112A, then in that particular case, the highest surcharge will be 15%, even if your dividend income exceeds 2 crore rupees, right? So your total income, excluding dividend income, LTCG, STCG is if it's more than 2 crores, then the highest surcharge of 25, 37% will be applicable respectively. But if your total income is like including only dividend, LTCG, STCG, then in that case, the highest surcharge will be 15%, right? Then what about the default regime, which is 115 BAC? What is the what are the tax rates in the default regime for individual HUF, AOP, BOI?
Under default regime, for every increment in 4 lakhs, we can increase 5% of tax rate for the
Correct.
member and citizen.
Correct. Very good. And any other income which is chargeable at special rate will continue to be taxed at the rate specified in those particular sections, right? Then what are the exemptions which are not allowed over here? We discussed that. So the exemptions which are not allowed over here are yeah, HRA, LTA, any special allowances, right? True travel conveyance allowance, transport allowance for handicapped is allowed, right? Then exemption for the minor's income clubbed in the hands of parent, 10AA, deduction for the entertainment allowance, profession tax, standard deduction is allowed. interest on self-occupied property, additional depreciation, right? Deduction of expenditure for tea, coffee, rubber development, site restoration funds, scientific research contribution to others, right? Specified deduction, specified business deduction, chapter 6A deduction, 80JJAA is allowed, 80LA is allowed. Any brought forward losses in relation to these deductions or any unabsorbed depreciation relating to the additional depreciation is not allowed, because normal depreciation is allowed, and therefore any unabsorbed depreciation in relation to normal depreciation will continue to be given, right? And any other brought forward losses will also be allowed. What are the deductions which are other than 80JJAA are allowed? 80CCD2. What was 80CCD2? The employer contribution to the NPS. How much is allowed under the new scheme? 14%, right? Even though under the old regime 10% is allowed in the 80CCD2, here it is 14% which is allowed, right? Interest on self-occupied property is not allowed. Interest on let out or deemed let out property is allowed. But in case if there is a loss, if there is a loss on let out property or deemed let out property, what will happen? What did we learn? If there is a loss on the let out or deemed let out property,
It will be adjusted on the same head, income from house property only. It will not be adjusted on any other.
yeah, it will not be allowed to be set off against any other head of income. It can be, of course, carried forward to the next year. However, it cannot be set off against any other head of income, right? Brought forward losses, you can carry forward and set off against the future year house property income. But any current year loss which is there under the house property, which is resulting in a loss, right? So then that will not be allowed to be set off against any other head of income. Are we clear? Yes or no? Okay. Then here one more point which I think we have not discussed is about the standard deduction. Now, the standard deduction which is there, which is allowable, usually is how much? How much is the standard deduction which is allowed?
Old regime it is 50,000. New regime 75,000.
Correct. So under the new regime, the standard deduction which is allowed is going to be 75,000. Are we clear? So the old regime, it is 50, and under the default regime, this is going to be 75,000. So just you can make a mention over here. Okay. Guram, there's a question. Once loss is carried forward, it's only set off against the same head of income. Yes, that's right. Okay. Fine. Now, what is the rebate which is okay? One more point before we move to the rebate, option to opt out, right? So, if a person has a PGBP income, then he can opt out only once, and that option will apply always. He can only withdraw that option, like come back to 115 BAC once, and once he comes back, he will never get an option to go out of 115 BAC. But if you have other than PGBP income, then you can exercise the option to opt out every year, right? Now, what is the surcharge under the 115 BAC or for 115 BAC?
50 lakhs to 1 crore, it is 10%. Greater than 1 crore to 2 crores, less than or equal to 2 crores, it is 15%. First is total income, including dividends, short term and long term, charged under section 11A, 111A, 112, and 112A. And from third onwards, total income, excluding dividend income and short term and long term, it is 25%. If it is greater than 2 crores, it is 25%. And dividend income, short term and long term, it is capped up to 15%.
Correct. Very good. And what are the rebates here? What is the rebate under 87A?
Tax amount of 60,000 maximum.
Correct.
On special rates, no rebate is allowed.
Correct. So you can Yeah, one more thing, which I would want to discuss regarding the rebate, right? So we discussed that day that under the normal tax, it is 12,500 for total income up to 5 lakh. Now, if you go for 115 BAC, if the total income is less than 12 lakh, it is 60,000. Fine. Now, one important point here, which I would like to highlight. Okay, let us look at 87A once again. So let me open the 87A for you. Is the screen visible? Yes.
Yes, ma'am.
Okay. Now, if you look at 87A, what did we discuss? An assessee being an individual resident in India, right? So this is only available to resident individual, right? A non-resident cannot claim 87A. Yes or no? That is one point. Whose total income does not exceed 5 lakh shall be entitled to a deduction from the income tax on his total income of an amount equal to 100% of the income tax or 12,500, whichever is less. So this is basically for the normal tax regime, right? So 12,500 or the tax, whichever is less, right? Now, it says provided that where the total income of the assessee is chargeable to under 115 BAC 1A and the total income does not exceed, this is not 7, this is 12 now, right? Does not exceed 7 lakh rupees. For your attempt, it is 7 lakh rupees. The assessee shall be entitled to the deduction from the income tax on his total income with which he is chargeable for any assessment year of an amount equal to 100% of income tax or 60,000 rupees. This is now 60,000, whichever is less, right? So if the total income is less than 12 lakh, then the 60,000 or the tax, whichever is lower, right? It additionally says if the total income, where the total income is chargeable to tax under 115 BAC and the total income exceeds 12 lakh, the total income exceeds 12 lakh, right? So here we are talking about first case, the total income is less than 12 lakh. They also provide for where the total income exceeds the 12 lakh. And the income tax on such total income. Income tax on such total income, right? So my income tax on such total income exceeds the amount. So income tax exceeds the amount by which the total income is in excess of 12 lakh rupees. This 7 is substituted with 12 now. The total income exceeds the amount by which, the income tax payable on such total income exceeds the amount by which the total income is in excess of 12 lakh rupees. Okay. So basically what they are saying, if my total income is more than 12 lakh and the income tax on that total income is greater than the total income minus 12 lakh, right? Exceeds the amount by which the total income is in excess of 12 lakh rupees. The assessee shall be entitled to a deduction from the amount of income tax on his total income of an amount equal to the amount by which the income tax payable on such total income. So what is my 87A in that particular case? So my 87A in that particular case shall be the amount by which the income tax payable on such total income, so my income tax, is in excess of the amount, right? Is in excess of the amount by which the total income exceeds 12 lakh rupees. So basically the difference of these two amounts. So even if my total income exceeds 12 lakh rupees, I will still get rebate if my income tax is greater than 12 lakh rupees. Sorry, if the total income is greater than 12 lakh rupees, I will get the rebate, which will be the difference between if my income tax is more than the total income minus 12 lakh. Do you want to understand it with an example? There is an example which is given in your module itself. Let us understand that. Okay. So let us look at this particular example. So see, here they have said it that if the total income of a resident individual which is chargeable to tax under 115 BAC. This is only applicable in case of 115 BAC and the total income exceeds 12 lakh and the income tax on such total income exceeds the amount of which by which the total income is more than 12 lakh. The rebate would be as follows. So total income minus 12 lakh is my step A. Step 2 is compute the income tax liability on total income. And if B is greater than A, then the rebate would be 87A. Under 87A would be B minus A. So, let's say Mr. Nitin, age 42 years and a resident in India has a total income of 12 lakh 15,000, comprising a salary and interest on bank fixed deposit. Compute his tax liability for AY 26-27 under the default tax regime under 115 BAC. Right? So, first of all, here my total income is more than 12 lakh 15,000. What will be the tax liability on 12 lakh 15,000? Yes. What is the tax liability on 12 lakh 15,000? Very quickly. Yes, Chitra, very good. 62,250 is the tax liability, right? 62,250 is my tax liability. Yes or no? Everybody getting this answer? 62,250. Everybody getting the tax liability on 12 lakh 15,000. Yes or no? Yes, Miruna, very good. Okay. Now, this, how much will be my rebate? So, what did I tell you? So, I told you here that here if you look at, if my total income is more than 12 lakh, right? Total income is more than 12 lakh, then in that particular case, if my income tax on that income, right? Income tax on that income, if it is more than the total income minus 12 lakh. So what is my total income minus 12 lakh?
15,000.
15,000. Is my income tax more than that? Yes,
Yes.
it is more
Yes.
than that. Yes, right? So in that particular case, what is my going to be the rebate? So my rebate amount would be the 62,250, which is my tax amount, minus the amount by which the total income is more than 12 lakh, which is 15,000. So 62,250 minus 15,000 will give me the rebate of 47,250. Are you getting it? Yes, correct, Sandeep. 47,250. So basically what you have to see is, if I have to, further simplify this particular point, is your step 1 should be to see what is the tax on the total income, right? My step 2 should be to identify the difference between the total income minus the 12 lakh. And step 3 would be 1 minus 2, which will be nothing but my 87A rebate. Are we clear about this, students? Yes or no? Is this clear? Yes or no, students?
Yes, ma'am.
Okay. So even if under the under the default regime, my total income is more than 12 lakh, I still end up getting the rebate, right? So this is what we had not discussed in the last class, but I thought we'll cover it over here. Okay. Secondly, as somebody rightly pointed out, that this particular section, if you look at it, it says the deduction under this first proviso, meaning this particular deduction, right? This deduction shall not exceed the amount of income tax payable as per the rates provided in 115 BAC 1A. What does this mean? This simply means that if you have any income chargeable to special rate, if you have any income chargeable to special rate under 112, 1128, 111A, then in that particular case, the rebate under 87A will not be allowed. Because what will happen, students, is that your income tax is not only now including the tax rate under 115 BSE, but is also including the tax under 112, 112A or any other special rate. Yes or no? So therefore, in that situation, what 87A is explicitly saying, that the rebate will only be restricted up to the rates provided in 115 BAC. It shall not exceed the amount of income tax as per the rates provided in 115 BAC. Are we clear? So you can write it over here. Oh, sorry, not income tax. Rebate under section 87A not exceed income tax under section 115 BAC. That is no rebate on special income. Sorry, income chargeable at special rate. Are we clear, students? Yes. Any questions? Any doubt? Yes. Is this clear?
Yes, ma'am.
Okay. So basically, what essentially we need to see is, under the old regime, you have the rebate, which is up to 12,500. But in the new regime, you have a rebate of 60,000. And even if your total income exceeds 12 lakh, then also you will get the rebate. Clear? Yes or no? Any questions, any doubt? Right? So, under the old regime, the rebate is allowed on all types of income except the long-term capital gain under 112A. See, there is no prohibition. If you go for the old regime, there is no provision with respect to disallowing you the rebate there against the special income. So in that particular case, you will get it for all the particular years, for all the particular income except 112A. Are we getting it? So under the old regime, the prohibition is not there. What they have given is the prohibition is for the income under 115BAC. Are we getting it? So the prohibition is only for 115BAC, not for the old regime. So the rebate under the old regime will continue to be applicable even on the special income. Are you getting this particular point, students? Except for the tax under 112A. Now you will ask why for only 112A, because 112A specifically restricts the claim of rebate. So you will write it over here. Is this clear, students? Yes or no?
Yes, ma'am.
So see, in exam, you can get tested in a very good manner with respect to this, right? Because in exam, you can get a question which will be a full-fledged question, students, and that can test you with respect to the uh, rebate, that can test you with respect to the different kind of allowances, disallowances. So you have to be very sure of all these concepts, what is allowed under new regime, what is not allowed under new regime, so that you don't end up making mistakes in the exam. Are we clear? So you have to be sure in the examination, how are we going to solve these questions? Clear? Yes or no? Fine. Next, we proceed towards the tax rate for the firm. Firm is 30%. Surcharge is, if the total income exceeds 1 crore, then you have a surcharge of 12%. This is on all the incomes, right? And any special income that will be chargeable to tax at the special rate. Then we did it for the cooperative society. So for the corporate society, the normal tax slabs are 10,000, 10%, 10 to 20, 20%, and more than 20, 30%, right? Surcharges 7 and 12% for income exceeding 1 crore or 10 crore. Then you saw 115 BAD, 115 BAE for manufacturing cooperative society, right? Now we move towards the company. Okay. So for the company. Now, first of all, let us understand what is the definition of a company. Let us go back to the Act. Okay. Let us see what is the definition of company over here. Here it is. Section 217 says company means any Indian company or any body corporate incorporated by or under the laws of a country outside India, or this is applicable before the 1st April 1970, so we are not looking at this one. Any institution, association or body, whether incorporated or not, and whether Indian or non-Indian, which is declared by a general or special order of the board to be a company, right? So basically we'll look at only these two first instances. Any Indian company or any body corporate by or under the laws of a country outside India. Means a company can be an Indian company, it can also be a foreign company, right? So then, although 217 doesn't talk about other company, we'll see the other companies also. 218 says company in which the public are substantially interested. A company is said to be a company in which the public are substantially interested if it is a company owned by the government or the RBI, or in which not less than 40% of the shares are held by the government or the RBI, or a corporation owned by that bank, or if it is a company which is registered under section 25 of the Companies Act, which is not profit company, if it is a company having no share capital, and if having regard to the objects, the nature and the composition of its membership and other relevant consideration, it is declared by the order of board to be a company in which the public are substantially interested, right? If it is a mutual benefit finance company, that is to say a company which carries on as its principal business the business of acceptance of deposits from its members and which is declared by central government to be a nidhi or mutual benefit company. If it is a company wherein shares, not being the shares entitled to a fixed rate of dividend, whether with or without a further right to participate in profits, carrying not less than 50% of voting power have been allotted unconditionally to or acquired unconditionally by and were throughout the relevant previous year beneficially held by one or more cooperative societies. If it is a company which is not a private company as defined in Companies Act and the conditions specified in A or B are fulfilled. A saying shares in the company not being the shares entitled to a fixed rate of dividend whether with or without a further right to participate in profit, whereas on the last day of the relevant previous year listed in a recognized stock exchange in India. Shares in a company which are not entitled to, not being the shares entitled to fixed rate of dividend, meaning the preference shares, whether with or without further right to participate in profit, carrying not less than 50% of the voting power have been allotted unconditionally to or acquired unconditionally by and were throughout the relevant previous year beneficially held by government, corporation established by the central, state or provisional act, any company to which the clause applies or any subsidiary company of such company if the whole of the share capital of such subsidiary company has been held by the parent company or by its nominees throughout the previous year. Right? Now, what does this mean? So, company in which public is substantially interested. What are these kind of company? First one, what we understood was the government company or the company owned by RBI. Fine. Next one was section 25 company, which is basically NPO. Third is mutual benefit or Nidhi company. Next is company owned by cooperative society. And the last one is listed company or a subsidiary of, can be private or unlisted, of the listed company. Now, why is this particular clause important? Company in which public is substantially interested. Can anybody tell me? Why is this company important? Yes.
Widely, it is widely company. More people are involved in this company. मीन्स बहुत जने के पैसे लगे हुए रहते हैं ना पब्लिक कंपनी में इन्वेस्ट करते हैं लोग
Yeah.
तो इट
But
तो
why is
इसलिए
this provision important?
there will be many rules and regulations on the such companies in the income tax act and for the private companies closely held companies the rules and regulations will be relaxed much more than these companies.
Sure. So see, this is a widely held company. So therefore, any company which is not a widely held is the closely held company or a company in which public is not substantially interested. Right? So you would see in several provision of the Income Tax Act which says that these sections specifically apply to only the company in which public is not substantially interested. For example, if you look at 222 dividend, 222E, any payment by a company not being a company in which the public are substantially interested. 222E is the giving of loans and advances to the shareholders. So this is applicable to a company which is a closely held company, because in a widely held company it is not necessary to check these provisions because the public is any which ways involved. But in a closely held company, one can easily give loans and advances to the shareholders. Isn't it? So therefore, there are many sections which are applicable to these kind of company. For example, look at this. Section 79. Restriction on carry forward and set off of losses of some company. This is specifically applicable to the company not being a company in which public is substantially interested. So in case there is change in the shareholding of any closely held company, section 79 will restrict the set off and carry forward of losses. Section 68. Again, it says assessee is a company not being a company in which public are substantially interested and where they are not able to explain the credit of the share application money, it will be considered as unexplained cash credit. Right? Then if you look at section 56, income from other sources. Here also you will identify there was one earlier provision which was applicable to the company in which the public is not substantially interested. This is no more now applicable, but this was earlier used to be there. Right? So these are the kind of sections which are more or less like anti-avoidance rule, which says that in these cases, the provisions will be applicable only to the closely held company, because they want to avoid the applicability of the provisions to all the companies. They only want to apply it to the closely held company because they feel like it is easier to avoid taxes in the closely held company. So you can just write it over here. Important for section 222E 79 68 etc. Clear? Then you have something called as company. Yes. 223A says foreign company means a company which is not a domestic company. So foreign company means a company which is not domestic company. Now here the word Indian company is used, but here they are saying domestic company. So means both are different. So what is Indian company? Let us see what is Indian company. Indian company means a company formed and registered under the Companies Act. Indian company means a company formed and registered under Companies Act. Are we clear? So therefore, what is the domestic company? Domestic company means an Indian company or any other company which in respect of its income liable to tax under this act has made the prescribed arrangements for the declaration and payment within India of the dividends payable out of such income. So who is a domestic company? Domestic company is an, one second. Give me a minute. An Indian company and a company which has made arrangement for declaration of dividend within India. Or let us write this as a foreign company, because it says any company means, so Indian company we have already covered, so this means foreign company. So domestic company means an Indian company or any other company, which is essentially going to be a foreign company, which in respect of its income liable to tax under this act has made the prescribed arrangements for the declaration and payment of dividends within the India payable out of such income. Now, it says prescribed arrangements. So obviously the arrangements are prescribed under, yes, arrangements will be prescribed under, where will be the
Rules.
arrangements? Yes, absolutely.
Rules.
Yes. So you need to check the income tax rule to see what are the arrangements prescribed under the rules, right? Isn't it? So the arrangements are prescribed under the rules. Whenever the word used is prescribed, it means that you need to go to the rules. Guram, not the company law, because if it is saying that company law, it will make a special reference to the company law itself. Right? So if it is saying that prescribed, so that means you need to go to the income tax rules. You can't go to the company law to see. Okay? So when we talk about the income tax rules, now income tax rule has prescribed the arrangements for the payment and declaration of the dividend in India. So what are the arrangements which are prescribed? So the arrangements for the dividend are basically like, let's say, for example, they are maintaining the register of the dividend in India, right? They are making the payment of dividend within India, right? So those are the arrangements which are prescribed. So Rule 27 is there, which prescribe the arrangements for the dividend in India, right? So if you look at Rule 27, let me show you. It says the arrangement referred to be made by the company for declaration and payment of dividend within India shall be share register is maintained at its principal place of business within India. General meeting for passing the accounts and for declaring the dividends shall be held only within India. Dividends declared, if any, shall be payable only within India to all the shareholders. So if any foreign company is making the arrangements for the declaration of dividend by maintaining the share register here, by holding the AGM over here, and by paying the dividend over here, it will also be regarded as a domestic company. Now, why is this difference important between a foreign company and a domestic company? What is the relevance of this difference between the foreign
Rate
company and domestic? Yes.
taxes.
Sorry,
Rate
I'm
of
not
taxes will
able to.
be rate of taxes will be different for a foreign company and
Very good. Yes, very
rate
good.
of taxes will be different for
Yes, very good. Yes, Guram. The rates will be different. Yes, Sandeep, the tax rates are different. So the tax rates, so this difference is relevant for the tax rates to identify the tax rates. Okay. Then you have something called as resident company and a non-resident company. Now this is identified on the basis of Section 6. A company is resident in India if it is having, if it's an Indian company or if it has the place of effective management in India. Otherwise, a company is a non-resident, right? So this is the test given under Section 6. So if it's an Indian company or foreign company having OM in India, right? And a non-resident company is basically other than resident company. Now tell me what is the relevance of resident and non-resident company?
scope of total income, section
Very
5.
good. Very good. So if it a company is a resident company, the global income will be taxable. If a company is a non-resident company, only income accrue or deemed to accrue or income received in India will be taxable in India. So this is to determine the scope of total income, not the tax rate. So even if a company, if a foreign company becomes the resident of India, the tax rate will still be that of a foreign company. A resident company is different from a domestic company. Remember this. A foreign company which has a POEM in India becomes a resident company and not a domestic company. Are we getting this point? Yes or no? So, it is very important to understand the differences between these kind of companies. Are we clear? Yes or no? Any questions? Now coming to the tax rates. First, we are talking about the domestic company. What is the general tax rate? Yes, 30%. Very good. So the general tax rate is 30%. Then we have a tax rate for these small companies. 25% is not the general rate, Gura. Yes, then we have the tax rate for the small companies. What is the tax rate and the threshold for the small companies? Yes, Sandeep, 25%, but what is the threshold? So if the turnover or the gross receipt in the previous year 23-24 is less than 400 crores, then it is 25%. Yes. So if the small companies are basically, if the turnover in previous year 23-24 is less than equal to 400 crores, it will be 25%. Fine. So these are the general tax rates that were there. Okay. Now, then you have the optional tax regime. One is Section 115 BAA and the second one is 715 BAB. Right? So first let's discuss about 115 BAA. This is tax on income of certain domestic company. Notwithstanding anything contained in this act, but subject to the provisions of this chapter. What does this mean? Now you will tell me because you have learnt about cooperative society, so you will explain me this section. Notwithstanding anything contained in this act, but subject to the provisions of this chapter.
Is a non-optional clause which says that it will override the entire act, but whatever the provisions are there in this chapter will be applicable.
Yeah, which provisions?
The special rate basically will be.
Correct. Very good. So the special rates will continue to be applicable, right? So basically, here we can make a third arrow and say income taxable at special rates. Example 112, 112A, 111A, taxed at specified rates. Fine. Yes. Then it says other than those mentioned in 115 BA and 115 BAB, because 115 BAB is a specific section, so that will be applicable. Fine. The income tax payable in respect of the total income of a person being a domestic company. Say they are using the word domestic company. For any previous year relevant to the assessment year beginning on or after 1/4/2020 shall at the option of such person, meaning this is the optional provision, be computed at the rate of 22% if the conditions in subsection 2 are satisfied. So what is the tax rate over here? Okay. What are the conditions under subsection 2? Sorry, provided that where the person fails to satisfy the conditions in subsection 2 in any previous year, the option shall become invalid in respect of the assessment year relevant to that previous year and the subsequent assessment year, and other provisions of the Act shall apply as if the option had not been exercised for the AY relevant to the previous year and the subsequent assessment year. What does this mean?
If conditions are not satisfied or fails to satisfy, then for that assessment year and all subsequent assessment year, 30% would apply.
Correct. Very good. Fine. Now, what this is, for the purpose of subsection 1, the total income of the company shall be computed without any deduction under the provisions of 10AA. What is 10AA?
Units in SEZ.
Very good. Units in SEZ, right? Yes, Guram. Or clause 2A of subsection 1, 2.
Additional depreciation.
Sorry. This is, yes, additional depreciation.
Additional depreciation.
Very good. This is additional depreciation. Or 33AB or 33ABA.
33AB tea, coffee, rubber production. 33ABA site restoration.
Very good. 2A3 of subsection 1 or 2AA or 2AB of section 35. What are these clauses?
Outhouse scientific research. Outhouse scientific research.
Yeah, but what about scientific research? What is there?
To universities, any research organization,
Correct.
persons, and statistical research.
Correct. Very good. Very good. So it is basically the contribution to national laboratory, IIT, outsiders, any contribution, any company is not going to be allowed. Yes, Sandeep, only in-house research is allowed. Very good. 35 AD.
Specified businesses.
Correct. 35 triple C double CD is basically agricultural related, or any other provision of chapter 6A other than the provision of 80 JJAA or ATM. What is 80 JJAA?
New employee.
Correct. What is ATM? For the intercorporate dividends. Okay, for the intercorporate dividend, ATM is there. Without set off of any loss carried forward or depreciation from any earlier assessment year if such loss or depreciation is attributable to any of the deductions referred to in clause 1. What does it mean?
If there are any losses or unabsorbed depreciation because of the exemptions which are in clause 1, it will not be allowed.
Correct.
For the subsequent.
Right. So what is this unabsorbed depreciation for?
Additional
depreciation.
Correct. So if it is normal depreciation which is unabsorbed, that will be allowed. Okay. Without set off of any loss or allowance for unabsorbed depreciation deemed so under 72A if such loss or depreciation is attributable to any of the deductions referred to in 1. So 72A is basically the losses under amalgamation demerger. So any loss of amalgamated company becomes the loss of the amalgamating company becomes the loss of amalgamated company. So even those losses which are pertaining to these deductions will not be allowed. by claiming the depreciation, if any, under the provisions of 32, except clause 2A of subsection 1 of the said section, determined in such manner as may be prescribed. What does this mean?
Normal depreciation shall be allowed.
Correct. Then, in case of a person having a united IFSC as referred to in exercise the option, in that particular case, this ATLA will also be allowed. Okay. Nothing contained in this section shall apply unless the option is exercised by the person in the prescribed manner on or before the due date under 139(1) for furnishing the returns of income for any previous year relevant to the assessment year after 1/4/2020, and such options once exercised shall apply to the subsequent assessment years, provided that in case of a person where the option is exercised by it under 115 BAB has been rendered invalid due to violation of the conditions in that section, then such person may exercise the option under this section. Okay. Once the option has been exercised, it cannot be subsequently withdrawn for the same or any other previous year. Are we clear? So I'm just putting the same points from the cooperative society over here, but you are going to write it in entirety. Are we clear?
Yes, ma'am.
Okay. So, 1 second, I have to copy it properly. I think 1 second. Are we clear? Yes or no? Okay, now let's move to the 115 BAB. Again, notwithstanding anything contained in this act, but subject to the provision of this chapter other than the 115 BAA. Okay, the income tax payable in respect of the total income of a person being a domestic company for any previous year relevant to the assessment year on or after 1/4/2020 shall at the option of such person be computed at the rate of 15% if the conditions in subsection 2 are satisfied. So, what is the tax rate over here? For 115 BAB, 15%.
15%.
Okay. Provided that where the total income of the person includes any income which has neither been derived from nor is incidental to manufacturing or production of an article or thing, and in respect of which no specific rate of tax has been provided separately in this chapter, such income shall be taxed at the rate of 22%, and no deduction or allowance in respect of expenditure or allowance shall be allowed in computing such income. What does this mean? Yes.
If any income which is not incidental to the manufacturing, uh, then it will be taxed at the rate of 22%, and also the expenses will not be allowed to reduce from the total income.
Okay. Yes. Very good. So in case there is any income which is not incidental to the manufacturing, right? Or the production, then in that particular case, what will happen is the income tax at the rate of 20% without any expenditure or the allowance, right? We had written this point even in the cooperative society. Yes. Then what does it say for the income tax payable in respect of the total income of the person deemed so under second proviso to subsection 6 shall be computed at the rate of 30%. So what is this subsection 6? Where it appears to the AO that owing to the close connection between the person to which this section applies and any other person or for any other reason, the course of the business between them is so arranged that the business transacted between them produces to the person more than ordinary profits, which might be expected to arise in such business. The AO shall, in computing the profit and gains of such business for the purposes of this section, take the amount of profits as may be reasonably deemed to have been derived therefrom, provided that in case of the aforesaid arrangement involves a specified domestic transaction, then the amount of profits from such transaction shall be determined having regard to the arm's length price. What does this mean? Yes, we had then discussed that day also.
If the person has unduly inflated its income by arrangement with owing to like other SSE, then the assessing officer shall charge those income at the rate of 30%.
Yeah, it's not like that. See, if let's say for example, let me explain one example for this so that it will become clearer. Yes, Guram, that's right. Yes, that's right, Sandeep. See, let's say for example, if there is a company A. Okay. Now this company A is, let's say, dealing with or making, let's say, the uh, purchases from company B. Okay. Or let's say it's making sales, not let's say purchases. Let's say it's making sales. Right. So where let's say for example, the sales were rupees 1 crore usually, and the profit should have been, let's say, rupees 10 lakh. Now, how will I get this? Let's say this is a retailer of shoes. Now, similar shoes retailer are producing more or less this turnover and this profit. Okay. But let's say it is making the sale of rupees 10 crore and profit of, let's say, rupees 1 crore. Now, if the AO feels this is more than ordinary profit, right? Because of the relationship between company A and company B. Because this is the subsidiary of company A, right? Now, why company A is doing that? Because under 115 BAB, the tax rate is 15%. So it obviously wants to book more profit here because company B tax rate is 30% and company A tax rate is 15%. Right? So it is trying to shift profits from company B to company A. So in that very case, the AO can say that the normal profits shall be 10 lakh. In case these are related entities, associated enterprises, right? Then in that case, the specified domestic transaction, it will be considered as specified domestic transaction that you will learn in your transfer pricing class, right? If the value of the transaction is more than 20 lakh. So in that case, the normal profits will be 10 lakh and the 90 lakh which is there shall be taxable at 30%. This is what the section says. Are we clear? So if it is STT, ALP applies and the excess income taxed at 30%. Clear? Yes or no? Is this clear? Yes, students.
Yes, ma'am.
Yes, madam. Yes, madam.
Okay. Provided that the income tax in respect of income being short-term capital gains derived from the transfer of a capital asset on which no depreciation is allowable under the Act shall be computed at the rate of 22%. What does this mean?
It's non-depreciable asset on which no depreciation allowed, which is capital asset for you. It will be taxed at 22%.
Correct. But here there is no restriction on claim of expenses. Fine. Then next is provided also that where the person fails to satisfy the conditions in subsection 2, the option shall become invalid in respect of that assessment year and the other provisions of the Act shall apply to the person as if the option had not been exercised for that assessment year and the subsequent assessment year. What does this mean? So if you fail to satisfy the condition under 115 BAA, you can go for normal tax regime. But under 115 BAB, you can go for 115 BAA still. Right? Yes or no? So if you fail to satisfy, you can opt for
Yes, madam.
115 BAA. Clear? For the purposes of subsection 1, the following conditions shall apply. The company has been set up and registered on or after 1st October 2019 and has commenced the manufacturing or production of an article or thing before 31st March 2024. So here you will write in the cooperative society the dates were different. This is set up on or after 1st October 2019. And commence the manufacturing before 1/4/2024. The business is not formed by splitting up or reconstruction of a business already in existence. Do not use machinery or plant previously used for any purpose. For the purposes of subclause 2, any machinery or plant which was used outside India by any other person shall not be regarded as machinery or plant previously used for any purpose if the following conditions are fulfilled, namely, such machinery or plant was not at any time previous to the date of installation used in India. Such machinery or plant is imported into India from any country outside India, and no reduction on account of depreciation in respect of such plant and machinery has been allowed or is allowable under the provisions of this Act in computing the total income of any person for any period prior to the date of installation of machinery or plant. What does this mean?
It should
Suppose
not be
if a
set
person
at
has
Yes, one by one. Yes. No depreciation has been claimed by any other person. Yes, Sandeep. But what does this exactly means? Which kind of plant and
yes,
machinery?
yes,
Yes, please.
yes, suppose if a person in India has used that machine, so he will be claiming the depreciation. So he will be exporting that machine, and then some another person is importing that machine. Since the another person has used that machine earlier before the installation by the second person, those plant and machineries are also not allowed.
See, here what it essentially means is that day we also learned for the cooperative society as well that business should not be formed from splitting up or reconstruction of any existing business. So you should not be using any old plant and machinery, but second-hand plant and machinery is allowed if it is an imported plant and machinery. So if it is imported from outside India and no person in India has ever used it, you can claim it. Second is whether in the case of a person, any machinery or plant or any part thereof has been previously thereof used for any purpose is put to use by company and the total value of such plant and machinery does not exceed 20% of the total value of machinery or plant, used by the company, then for the purposes of clause 2 of this clause, the conditions specified therein shall be deemed to have been complied with. What does this mean? Sorry. What does this explanation 2 means?
Value of the second-hand machine can be up to the 20% of the total value of the plant and machine.
Correct. So second-hand plant and machinery, even if it is not imported, can be up to 20% of the total plant and machinery. Fine. Next condition is the company is not engaged in the business other than the business of manufacture or production of any article or thing, or in any research in relation to and any distribution of such article or thing manufactured or produced by it. And they have said it is clarified that the business of manufacture shall not include business of development of computer software, mining, conversion of marble blocks or similar item into slabs, bottling of gas into cylinder, printing of books or production of cinematograph film, same as cooperative society. The total income has been computed without deduction of 10AA, without additional depreciation, without the tea, coffee, rubber development, site restoration fund, contribution for scientific research, specified business, right? And any other provisions of Chapter 6A other than 80JJAA and 80M. Okay. So again, this is the same that we had written, that this is without any deduction. Here you can add one more deduction. What is allowed is 80LA, 80JJAA plus 80M. Okay. Any brought forward business loss pertaining to these deductions or any unabsorbed depreciation pertaining to the additional depreciation, right? Normal depreciation will be allowed. The loss referred to in subclause 2 or of subsection 2 shall be deemed to have been given full effect and no further deduction will be allowed, right? Then finally it says nothing contained in this section shall apply unless the option is exercised by the person in the prescribed manner on or before the due date of 139(1) for furnishing the first of the returns for any previous year relevant to the assessment year after 1/4/2020, and such option once exercised shall apply to all the other subsequent assessment years, provided that once the option has been exercised for any previous year, it cannot be subsequently withdrawn for the same or other previous year. What does this mean now? Sorry. What does this last point mean? Subsection
So we
7.
have to opt for the 115,
Yeah,
opt for the 115 BAB when he is filing his return for the first time.
correct.
Subsequently,
The first.
he cannot opt. Whereas 115 BA, we can opt for it at any time.
Correct. Very good. So you have to opt for the return before filing your first return of income. Once option exercise, you cannot withdraw. Whereas 115 BAB, you can exercise at any point in time. Is this clear, students? Yes or no? See, you have only answered all the questions by yourself. You are able to read the section by yourself, isn't it? Now you know how to read the act also. So you're doing it all by yourself. You're understanding it all by yourself. I'm just, saying yes or no to what you're saying. Yes? Now let's come to the next point, which is the surcharge. Where do you find the surcharge, students?
Schedule 1, Part 3 of Finance Act.
Very good. So, what is the surcharge for the Yes Sandeep in the Finance Act? Schedule 1, Part 3. What is the surcharge for the companies? Yes. Should we go to Schedule 3 and look at it? You'll be able to find in Section 2 also. Let me search the word surcharge for the companies. Yeah. In case of every company, this is other than domestic. Where is the domestic company written word? Yes. In case of every domestic company except the domestic company whose income is chargeable under 115BA or 115BAB at the rate of 7%, where the total income exceeds 1 crore but does not exceed 10 crore, isn't it? So it's same like cooperative society. If my total income is greater than 1 crore, less than rupees 10 crore, surcharge is 7%. If my total income is exceeding rupees 10 crore, surcharge is 12%. Yes? Fine. What is the surcharge for the 115 BAA and 115 BAB? Yes. 10%. Very good. Yes, Gaurav, it's 10%. So, in case of every domestic company whose income is chargeable to tax under 115 BAA, BAB, the income tax shall be increased by surcharge at the rate of 10%. So, this is at the flat rate of 10%. Here also surcharge is 10%. And here also this will be added by surcharge of 10%. So even your income which is not incidental to the manufacturing or any other income that you have, this is also added with surcharge of 10%. Your STCG or non-depreciable asset also at 10%. And the income greater than ALP is also added with surcharge of 10%. Are we clear? Yes? Yes
Yes,
or no?
ma'am.
Okay. Finally, what is the tax rate for the foreign company? So this we understood for the domestic company. What about the foreign company? %35. Very good. So the income tax is 35%. Where is it given?
Finance Act.
Correct. And the surcharge is 2%. And if it is more than 10 crore, this is 5%. Fine. If you look at it, here only in the section 2 itself, they have given 2% and 5% is the rate of surcharge. Clear? So this is about the tax rate for the company. Okay? Any question, any doubt? Yes? Yes or no? All the tax rates are done thoroughly for you. Yes or no, students? Any questions, any doubt?
No, ma'am. No, ma'am.
Clear to everyone? Yes, good.
Yes, ma'am.
Okay. Now, what is remaining in this chapter is the difference between the capital receipts and the revenue receipts. So, see students, the rule of law is that the revenue receipts are always chargeable to tax unless specifically exempted. Whereas the capital receipts can only be taxed when it is specifically provided. Isn't it? Same goes with the expenditure. Revenue expenditure is always allowed unless specifically disallowed. Capital expenditure is only allowed only when it is specified in the law. Okay, so you can write it over here. Revenue receipts, these are always taxable unless exempt, and capital receipts are taxed only when specified. Under definition of the income. Similarly, revenue expenditure always allowed as deduction unless disallowed, and capex is only allowed as deduction if specifically provided. Are we clear? Now, what is a capital receipt and what is a revenue receipt? Yes.
When we say sell the capital assets, we will get the capital revenue. Also, and if for it's a business like we are doing day-to-day transactions and we are doing business, then it is revenue receipt.
Yeah. It is not only about business or non-business income. Yes, Sandeep, capital receipt is something which affect the capital account. So any transactions which are capital account transaction, which is affecting your loans liabilities, which is affecting your receivables payables, which is affecting your, let's say for example, the share capital, which is affecting your, let's say fixed assets, all these balance sheet receipts which are there, that are capital receipt. Revenue receipts are routine, ordinary course of activity that you undertake, that is revenue receipt. Your dividend, even if it is not business income, it is revenue receipt because this is recurring. Interest, even if it is not business income, it is recurring. It is revenue receipt. What is capital expenditure? Same way. Any expenditure which enhances the life of asset, which enhances the performance of asset, which gives you the advantage of enduring nature, right? Long-term advantage. That is a capital expenditure. Routine, regular, day-to-day expenditure, any advertisement expenditure, right? Any expenditure for research and development, that is basically your revenue expenditure, right? Now, in this relation, we have certain case laws. Let us look at these cases from the module. What are the cases which are given in the module for this revenue and capital? Now, one is the Supreme Court ruling, latest ruling of Bank of Rajasthan, whether the interest paid by the banks for broken period on purchase of securities can be claimed as revenue expenditure. First of all, what is the broken period interest? Can anybody tell me? You have learned this in your IPCC CPD. What is a broken period interest? See, broken period interest means, let's say for example, if I purchase the security, right? Securities are interest bearing, right? Generally, these government securities are interest bearing security, right? Now, let's say I'm purchasing the security on 10th of July, right? Now, the interest on that is due on month to month basis, right? Now, I have, as a seller, have held the security from 1 to 9. The purchaser is holding the security from 10 to 31st with the interest due on 1st of August. Right? So for the first 10 days, the seller has held that security. So he will say, you give me the interest for those 10 days. Why should you get the entire interest when you have held the security only from 10th? He's right, isn't it? So this buyer has to pay the 10 days interest to the seller. That is known as the broken period interest. It is written here in your module also, when a bank purchases a security on the date which falls between the date on which interest is payable on the security, the purchaser bank, in addition to the price of security, has to pay an amount equivalent to the interest accrued from the period from last interest payment till the date of purchase. This is known as broken period interest. Now, whether this is capex or whether this is revenue, come interest security. Yes, Sandeep. This is capex or this is revenue? The example is, Quran, the same thing that I told you. Let's say the interest is due on every 1st of month. I purchase the security on 10th of July. So I have to pay the interest for 1 to 9 to the seller because he had held for those 9 days. So he is, liable to get that interest. If he had not sold the security, he would have got those 10 days ka interest. Now, when I am purchasing, I am holding only from 10th. So when the interest will come on 1st of that month, what will happen? I will get even for those 10 days. But I didn't hold it for those 10 days. It was held by the seller. So I will have to pay seller that 10 days interest. That's a broken period. If it is stock in trade, then revenue, otherwise capital receipt. Let's see what the Supreme Court had said. So here the bank had purchased it, right? And the bank had classified these securities as stock in trade. So the bank here, Bank of Rajasthan, had followed the method of netting off the interest paid minus interest received. Right? So the bank, what it used to do is, when it also used to sell the securities, it also used to receive the interest. So it had net off the interest received minus interest paid. So here the court noted that the banks are required to purchase these government security to maintain the statutory liquidity ratio, SLR, right? And there are 3 categories of the securities: held to maturity, available for sale, available for trading. As far as the available for sale and held for trading are concerned, banks are holding these securities as stock in trade. Therefore, in these 2 categories of security, the benefit of deduction of the interest for broken period will be available. So, as you rightly pointed out, that if it is, Guram, you said that if it is held as stock in trade, then it is revenue. If it is held as the capital asset, then it is capital receipt. So, that's very correct. So, the securities which are held for maturity, like which are held for a longer term period, that will be long term, and that interest which is there, that deduction of that interest will not be available because it will be the capital expenditure. However, for the held for sale, available for sale and held for trading, it is considered as stock in trade in the balance sheet, so interest will be considered as revenue expenditure. Are we clear about this judgment, students? Yes? Any question, any doubt? Okay? Yes or no? Clear. Okay. Next judgment is The Supreme Court judgment, again the recent one in Adan Technologies, whether the expenses incurred by the assessee towards the development of software for advertisement which due to technological development had to be abandoned can be claimed as revenue expenditure. So here this is a technology company. It is conducting some kind of research to develop some software, right? And it had incurred the significant expenditure for the online advertising, right? So, however, you see that the technology changes very rapidly. 5 years, 10 years back, we didn't have this chat GPT. Once chat GPT came, we came up with, also we saw Gemini. Today we have Grok, we have Perplexity, so many other modules. So this rapid change in the technology obviously sometimes result in discarding the entire software, because the technology that you have used is now obsolete. For example, many years back, we used to have only Amazon. Today, we have Blinkit and Zepto. So many apps just, had gone away from the market who had entered at one point in time. Now, the question is that years since the product has been abandoned, the software had been abandoned, the assessee ideally did not get any benefit out of that software. So the assessee had incurred the expenditure to develop the software, but due to change in the technology, it had to finally abandon the software. So it had lost the money spent on developing the software. So whether this is revenue expenditure or capital expenditure? Capital, why capital? So here the Supreme Court observed that the High Court in fact observed that the assessee had not got any benefit from the software. If it had, developed the software, it had received an enduring benefit, a long-term benefit, then it would have been a capital expenditure. Here it had to just abandon. So this is normal part and parcel of the assessee's business to do the research, develop the software, and in case, it is not developed, it is abandoned. So this will be the revenue expenditure. Now, the revenue had filed the SLP before the Supreme Court against the High Court decision. And the Supreme Court dismissed the SLP. What is SLP? Any idea? What is SLP? SLP is Special Leave Petition. Right? SLP is the appeal to the Supreme Court is made by way of a special leave petition, right, against the High Court. Now, ideally, a special leave petition, if the Supreme Court does not find any grounds, right, to entertain that SLP, then it can just dismiss that SLP. And if the SLP is dismissed by the Supreme Court without any detailed reasons, then generally it does not create any binding precedent. It doesn't mean that this order will be followed by all the lower courts. It can be binding on that assessee, but it is not binding on the every other court. So dismissal of SLP means that the Supreme Court do not want to entertain this case because it doesn't feel like that it is worthy enough to entertain this. Are we clear? So this is not a binding precedent, but of course, this is a very good case from the High Court at least point of view. This has attained the finality. Okay? Yes or no?
Yes, ma'am.
Okay? Okay. Next case is again Supreme Court ruling. Can a foregoing a security deposit to settle a dispute be considered as revenue expenditure? So in this case, the assessee had sought to vacate certain leased premises. And there was some dispute between, usual dispute between the landlord and tenant. And to end that dispute with the landlord, the assessee agreed not to claim back the security deposits. Generally, you see tenants give the security deposit to the lessor or landlord, right? Now, this foregoing security deposit, is it a revenue expenditure or capital expenditure? It is a capital expenditure, right? It's a security deposit. So this can't be claimed as a revenue expenditure. So the court held that the amount could not be treated as revenue expenditure merely because it was paid in the course of a dispute. It was a capital item and therefore it can't be allowed. Fine. Next is
Ma'am,
again
one question in this.
yeah,
Suppose there is a dispute between tenant and the landlord, and the tenant is supposed to pay some amount as per the dispute resolution. That will be revenue.
yeah, that will be revenue.
Then
But
this
then
is
also
also in
depends,
this.
what kind of amount that you are paying, right? See, if it is a dispute related amount that, you have to bear some, liabilities, huge liabilities you have to pay to, end that dispute, then obviously that is capital again. But if let's say, for example, you pay, some punitive charges that you have not, vacated on time, something of that sort, then it's a revenue. So it depends, what are the charges. Okay.
Okay.
Next is very important old decision of Supreme Court in Saurashtra Cement, which is in the nature of liquidated damages received. So, like let's say for example, if you do not supply the machinery on time, so generally the supplier of the machinery, if he doesn't supply it on time, then obviously the delay results in delay in manufacturing for the buyer. So he may put it in the contract that we will charge some liquidated damages. So if the liquidated damages are received by a company from the supplier, the buyer receives these liquidated damages because of delay in supply of machinery, whether it is a capital receipt or a revenue receipt. So the Supreme Court in this case answered that these damages are linked with the procurement of a capital asset, which leads to delay in coming into existence of the capital asset itself, or delay in coming into existence of a profit making apparatus. This is very, very important word. Profit making apparatus meaning profit generating capital asset. So this is not a receipt in the course of profit earning process. Therefore, the amount received by the assessee towards compensation for sterilization of the profit earning source, right? Because you are not supplying me the machinery on time, this is leading to delay in me able to generate the profits. So this is sterilizing my profit earning source. The source of that earning profit was capital asset, machinery. And you have sterilized that. Because of your delay, that is sterilized, that is hindered. So any compensation for sterilization of the profit earning source is not in the ordinary course of business, and hence it is a capital receipt in the hands of the assessee. Are we clear? However, let me show you one particular section. Okay? What does this section says? Let us look at it. So as I told you, capital receipts are always not taxable unless specifically charged to tax. Sorry, this is Finance Act. Let me open the Income Tax Act. So if you look at section 28, profit and gains of business or profession, the following income shall be chargeable to income tax under the head PGBP. What is the income? Subclause 2. Any compensation or other payment due to or received by, right? Any compensation which is due to or received by, clause E, person by whatever name call at or in connection with the termination or modification of the terms and conditions of any contract relating to his business, his chargeable under the head PGBP. So this clause E overrides the Saurashtra Cement case. Saurashtra Cement says what? Any liquidated damages which are as a compensation towards the sterilization of profit making apparatus is a capital receipt. But 28(2) says any compensation which is received in connection with the or modification of the terms of contract shall be chargeable under head PGBP. So capital receipt is not chargeable to tax, but here it is specifically made chargeable to tax. Are we clear? Yes or no? Fine.
Yes, ma'am.
Okay. Last one. Whether technical fee paid under a technical collaboration agreement for setting up a joint venture company in India is revenue or capital upon the termination of the agreement. So here Honda CL case is there of Supreme Court. Here what had happened is that there was some technical fee paid under the technical collaboration agreement. Now this was paid with respect to usage of technical know-how. This technical know-how was obtained for improvising the existing business of the Honda cars. So they are into the manufacturing of cars. So obviously, they import a lot of technical know-how services to how to improvise the design of cars and know-how, right? So here the purpose of the technical collaboration agreement was to venture in India. So here this particular agreement enabled transfer of technology, assistance in basically respect of establishment of that plant and machinery to set up a manufacturing unit in India. And once this agreement will end, the entire joint venture will come to an end. So therefore, the Supreme Court said that this is a capital in nature item because upon the termination of the agreement, the joint venture itself would come to an end. So in this particular case, this is a capital expenditure which is not chargeable to tax. Are we clear? So basically, as I said, you have to remember that all the receipts revenue receipts are taxable unless exempt. So if you see all the incomes which are there are taxable unless they are specifically exempt under section 10. Right? Capital receipts can only be taxed only when specified in the definition of income. For example, liquidation damages. Not liquidation. Sorry. For example, damages or compensation with respect to the delay in supply of plant and machinery, right? Liquidated damages. Compensation. Right? Okay. Again, revenue expenditure are always allowed as deduction unless specifically disallowed. So if you see there are disallowances under 36, 37, 43, right? 40. So otherwise they are always allowed. Capital expenditure are only allowed only when specifically provided. For example, 35 AD specified business deduction, 33 AB tea, coffee, rubber development, 35 has certain deduction for the scientific research capital expenditure also, right? So, or your 80 IA, right? Here also capital expenditures are allowed. So, in these particular cases, so not 80 IA, 80 IA is chapter 60 deduction for the profits, not 80 IA, sorry. Yeah. So, these are certain specific deductions which are allowed even though they are capital in nature. Are we clear? So, capital expenditure can only be allowed when it is specifically provided. Are we clear? Any questions, any doubt before we go on to the break? Yes, shall we take a break? Okay. income which do not form part of the total income, right? Exempt income. So tell me one thing, what is the difference between the exempt income and the deductions? Yes.
Exempt income do not form the part of total income, while deduction first forms part of the income, then it gets deducted.
Very good. So income is exempt means it doesn't enter the total income. It is excluded at the threshold, right? It doesn't enter into the computation of total income altogether. Whereas deduction means first you include it into the income and then you claim the deduction from that income. For example, ATIA, ATIB, all these profit linked deductions which are there. What it does is basically first you include the revenue from these particular specific sectors for which you get ATIA, ATIB deduction for infrastructure development and all of that. And then you claim that as a deduction from your total income. That income is claimed as a deduction based on that formula which is here. Right? Similarly, dividend, if a company receives a dividend from another company, it is included in the total income. And then if this company which has received the dividend further declares the dividend before the 1 month of filing the income tax return, it can claim the deduction under ATM for that dividend income received. Right? So it is first included in total income and then you get the deduction therefrom. So now we are going to discuss here exemptions. Now, exemption under section 10, right? Now there are certain exemptions which are discussed under the relevant chapters also. For example, if you talk about the capital gain chapter, capital gain on transfer of unit schemes, capital gain on compulsory acquisition of agricultural land, urban agricultural land, 1037, that will deal in the capital gain class. Income received in the reverse mortgage, that we will see in the capital gain class. Receipts from the LIC, ULIP, we'll see in IFOS. Right? Family pensions, we'll see in IFOS. Exemption for the minor's income clubbed in the hands of parent, we saw that day also, but we'll see in the clubbing of income class. Right? Then other income exempt in terms of payment from NPS trust to the assessee on closure of his account or on his opting out of the pension scheme. You will see that when we will deal with the pension under the chapter 6A, right? Or on the partial withdrawal. Then there are certain incomes which are exempt in relation to the charitable trust institution, securitization trust, investment trust, AIFs, or business trust that we will see in assessment of various entities class. So those are the income which are specifically dealt in different chapters. So we'll not touch upon here. For example, interest on money standing in the NRE account, interest on NRE account, that we'll see in international tax class, interest on the RDBs, rupee denominated bonds, right? Interest or royalty on account of lease of aircraft or ship, remuneration by the foreign employees, right? So these are certain sections which we are going to specifically see in separate chapters. Now what we are going to see is first the agricultural income. What did I tell you? Why is agricultural income exempt? That day we had a discussion. Why is agricultural income exempt?
Because entry 82 says that other than tax, the power to gives power to levy tax other than on agricultural.
Correct. So the state has the power to levy tax on agricultural income, right? So central government has no power to levy tax on the agricultural income, and it says entry 82 of list 1 of 7th schedule says tax on income other than the income. So central government, and that's the reason why 10.1 provides agricultural income will not be included in my total income. Now, what is agricultural incomes? That is defined in section 2.1. So this definition covers the income of not only the cultivators who are cultivating on that land, but also the people who are holding the agricultural land. That's the reason why you also see agricultural land, rural agricultural land is not a capital asset. Rural agricultural land is not a capital asset. Now, agricultural income, if you look at section 2.1a, let us look at it. Sorry. Agricultural income means any rent or revenue derived from a land which is situated in India and is used for agricultural purposes. So it is not only concerning the revenue derived from the land, but it is also saying rent derived from the agricultural land. If you are letting out the agricultural land, then any rent derived from a land situated in India and used for agricultural purposes will not be taxable or will be considered as agricultural income. So not only the revenue from the land, but also the rental from the land will be considered as agricultural income. Now it says land situated in India, meaning it has to be the agricultural income from a land situated in India. If I cultivate on a foreign agricultural land, will it be regarded as agricultural income in India? Yes or no?
Agricultural income, but not exempt.
Correct. It may not be regarded as agricultural income only, because here agricultural income under 2.1 it says rent or revenue derived from a land which is situated in India and is used for agricultural purposes. Now, what do we mean by agricultural purposes? Yes. What do we mean by agricultural purposes? Yes, student. Whatever we are growing crops on, right? So that is the agricultural purpose. So basically, if the land is used for cultivation of crops, only then, let's say for example, I have agricultural land, but I'm using it for, let's say, building a mall, and I'm deriving the rent from that let out of shops. Will it be agricultural income?
No, madam.
No, right? So it has to be derived from the agricultural purposes. Although the term agricultural purpose has not been defined in the Act, but generally what we understand from the agriculture mean? Basically sowing of seeds, growing of crops, cultivation, right? Which are basically to grow the produce from the land. Or any kind of operations where I'm, doing like, cleaning of those particular produce that has, right, of vegetables which is there. So any like basic operations or the subsequent operation. So if you look at your module, they have drawn this chart also, that any basic operations or subsequent operation to be performed after the produce of these sprouts from the land. Right? So both can be called as agriculture purpose, not only growing, but even any ancillary operations in relation to the agriculture, like in terms of growing the crops. Now, this can be any produce. It can be fruits, it can be grains, it can be vegetables, whatever it can be. It can be even grass. It can be pasture for consumption of beast, or can be coffee, tea, spices, tobacco, commercial crops like cotton, jute, indigo, whatever it will be. It should be only some kind of crop which is for the consumption for either the trade, commerce, will also include the forest produce such as tendu leaves and all of that. However, what they say is that the term agriculture cannot be extended to all the activities which have distant relation to land, like dairy farming. Now, obviously, dairy farming is not agricultural. Breeding is not agriculture. Tomorrow you will say we are rearing the cow, we are rearing the buffalo for using on the, or ox for using on the agricultural land. That is not the agriculture. So any kind of dairy farming, breeding, rearing of stock, butter and cheese making, poultry farming, all of these are not agriculture. Even poultry farming is not. It has to be from the cultivation of the land. Are we clear? So agriculture is not defined, but what is essential is that it should be from the cultivation of a field involving human skill and labor. And only when the land is used for agricultural purposes, only then your income will be agricultural in nature. Are we clear? Yes or no? Now,
Yes, ma'am.
tell me one thing, whether income from the nursery constitutes the agricultural income? Income from nursery, whether do you think it constitutes the agricultural income?
Yes, ma'am. Because those are also they will be growing plants and they will be selling, right?
See, here there are different views which are given by the courts. Now, Supreme Court in Raja Kumar Binoy had held that the basic operations must be performed before any income can be called as agricultural income. The basic operations like cultivation of land, tilling of land, sowing of seeds, planting, or any other operations which require the human labor and skill on the land, and to make that crop grow from the land, right? So income derived from sale of plants grown directly in the pots. In the nursery, you see that the crops are grown in the pots, not in the land, would not be treated as agricultural income. However, Madras High Court in Saundarya Nursery observed that the nursing activity involves carrying out first the operations on the land before the saplings are transplanted in the pots or in the containers, and then they are kept in the greenhouses for further growth. Therefore, the income is agricultural income because first that this, what do we call, the uh, basically the sand, which is not the sand exactly, but basically the kind of operation that is first conducted on the land, right, to make that crop grow, to make that plant grow, is conducted on the land using those fertilizers, natural fertilizers which are there, right? So basically that usage of that mud is very, very important, right? So therefore it is agricultural income. Now if you go to 2.1a, there is an explanation. Explanation is saying what? This explanation 3 is saying that for the purpose of this clause, any income derived from saplings or the seedlings grown in a nursery shall be deemed to be the agricultural income. So any income derived, now they have specifically said income derived from saplings or seedlings grown in nursery shall be deemed to be the agricultural income. Are we clear? So first part is rent or revenue derived from the land situated in India used for the agricultural purposes. Right? Now that rent can be derived by either the owner or the tenant can also derive by subletting the property, the agricultural property. So ownership of land is not necessary. Are we clear? Now, second important point is here that when you look at the agricultural income definition, what it additionally says is any income derived from such land by agriculture or the performance by a cultivator or the receiver of rent in kind of any process ordinarily employed by a cultivator of rent in kind, render the produce raised or received by him fit to be taken to the market, or sale by a cultivator or receiver of rent in kind of the produce raised or received by him in respect of which no process has been performed other than the process of the nature described in para 2 of this subclause. Now, what does this mean? So, first is saying rent or revenue derived from the land. Second is saying any income derived from such land, which is land situated in India and which is used for agricultural purposes by way of doing the agricultural activities, or by performance by a cultivator or receiver of rent in kind of any process which renders the produce which is raised or received by him to be taken to the market. So, process ordinarily employed to render the produce fit to be taken to the market. Now, what does it say? So, to make the agricultural produce a sellable product, right? You cannot, just sell the crops. Once the tomatoes grow, you segregate between the raw and the tomatoes which are ready to be used, right? It is necessary to perform some kind of process on the produce. So, you have to sometimes, like if you talk about tea, if you talk about coffee, you have to dry it, crush it, right? So the process which is employed to render the produce fit to be taken to the market includes several processes. Like, when you talk about the grains, you have to winnow the grains, right? Or if you talk about the rice, so the process employed by the cultivator of the rice is from the paddy is to first remove the hay from the grain and thereafter remove the chaff from the grain. Then the grain has to be filtered to remove the stones. And finally, the rice has to be packed in the bags for sale in the market. So the income from the process employed to render the produce fit to be taken to the market, to make it a sellable so any kind of process which is employed by the cultivator to make it as a sellable would be agricultural income. So it must be a process which is employed and which should be to make the commodity sellable. Right? So the process of making the wheat, rice, tea, coffee ready may involve some manual operations or may involve use of some machinery. All of these operations are basically eligible for the purpose of considering it as agricultural income. Right? So, any kind of such income which is derived by the cultivator, any kind of these performance by the cultivator or receiver of rent in kind. Receiver of rent in kind means, let's say I have received this agricultural commodity, I have received this tea, coffee, I have received this rice or wheat. So any income which is derived by the performance. Let's say I am not cultivating, but I am doing this kind of performance where I am, winning, or where I am, removing that hay or chaff, right? Then I will get that income for doing that performance. Or I have a factory to crush that coffee. So I am getting the income to do that particular activity. That will also be considered as the agricultural income if this process is there to sell the produce in the market. Are we clear? However, if let's say for example, I'm putting that particular coffee in small bag, right? So I'm doing this marketing, like putting the labels, putting the prices, all of that. The income from that will be partly agricultural and partly business. Any produce which is sold in a raw form and any marketing process is performed on that, the income therefrom will be partly agriculture and partly business income. Are we clear till now? Yes or no? Yes.
Yes, ma'am.
Okay. Now, the sale of such agricultural produce in the market. So, any income from the sale of any produce to the cultivator or receiver of rent in kind is agricultural income provided it is from the land situated in India and used for agriculture purpose. However, if the produce is subject to any process other than the ones which are normally employed to make it sellable, the income would be partly agriculture, partly non-agriculture. For example, if tea, coffee, rubber, tobacco, sugar cane are subject to further manufacturing. Like for example, from sugarcane you can manufacture sugar, right? From tea you will manufacture, let's say you will make it like some tea syrup or some like something like that. So then if you're manufacturing that particular produce, you're not selling as is, you're not selling the produce as is. Like if I just grow tea, do the normal procedure to make it like clean and sell it in the market, that is agricultural income, right? So any process which is required to sell it in the raw form only, that is agriculture income. If I manufacture something from it, it will be partly agriculture, partly business income. Are we clear? If I'm doing marketing on that, that is partly agriculture, partly business income. Are we clear about this? So in this particular case, if it is partly agricultural, partly business income, so in that particular case, we have to look at rules 7, 7A, 7B and 8 of the income tax rule, which provides for the apportionment of income between the agricultural and non-agricultural income. Rule 7 says income from growing and manufacturing of any product. So it says where income is partially agriculture and partially non-agriculture as business income, the market value of any agricultural produce which has been raised by the assessee or received by him as rent in kind and which has been utilized as a raw material in such business, or the sale receipts of which are included in the business income, that will be considered as my income, the market value of the agricultural produce. And no further deduction shall be made in respect of any expenditure incurred by the assessee as a cultivator or receiver of rent in kind. How the market value will be determined? So the market value is basically the agriculture produce if it is capable of being sold in its raw form or after making some modification or using some process to make it sellable. The value shall be the average price at which it will be sold during the particular year in the market, like the market value. It is possible that the agriculture produce is not capable of being sold in the market in its raw form or after using any ordinary process also. In such case, the market value will be the total of the expenses of cultivation, the land revenue or rent paid for the area in which it is grown, and amount as the assessing officer may think fit to represent a reasonable profit. For example, they have given here an example. Mr. Amar grows sugarcane and uses the same for the purpose of manufacturing sugar in his factory. 40% of sugarcane produce is sold for 12 lakhs and the cost of cultivation of sugarcane is 6 lakh. The cost of cultivation for the balanced sugarcane is 15 lakh and the market value is 25 lakh. After incurring 1.5 lakh in the manufacturing process on the balanced sugarcane, The sugar was sold for 30 lakh. Compute the business income and the agricultural income. How will you do it? Yes. How will you do it? What is your agriculture? What is my business income?
Business income is 3.5 lakhs.
Business income is 3.5 lakh. Yes, very good. What is agricultural income?
6 lakhs in first case,
Hmm.
40%, and in this case 10 lakhs.
Very good. Yes. So here students, as I said that first of all, where income is partially agriculture and partially is non-agriculture, then in that particular case, the market value of any agricultural produce, right, which has been raised by the assessee or received by him as rent in kind and which has been utilized as a raw material in such business, or the sale receipts of which are included in the accounts of the business shall be deducted, right? So how does the market value is to be utilized, determined? The agricultural produce is capable of being sold in the market either in its raw stage or after the application of an ordinary process which makes it sellable. In such case, the value will be average price at which it has been so sold. Now the sugarcane can be sold as is, right? So here 40% of sugarcane produce is sold for 12 lakhs. Cost of cultivation is given 6 lakh, right? Now the cost of cultivation of 60% sugarcane is 15 lakh and the market value is 25 lakh of that sugarcane. After incurring 1.5 lakhs of the manufacturing, the sugar was sold for 30 lakhs. Now, our business income will be sale proceeds 30 lakh for sugar, right? 1.5 lakh for manufacturing, I will deduct. I will deduct this cost of cultivation, sorry, the market value of the sugar cane, which is 60%, right? So 25 lakh is the market value of sugar cane which I will reduce. The market value of the raw material. The market value of the agricultural produce will be reduced to arrive at the business income. Are we getting? So my business income is 3.5 lakh. My agricultural income will be market value of sugar 60%, which is there, which is 25 lakh, right? And cost of cultivation. What is the cost of cultivation? 15 lakh, right? So this will be my agricultural income. Isn't it? And for the balance sale of sugarcane, 40% is, it has been sold for 12 lakh. Cost of cultivation is 6 lakh. So 6 lakh will be the agriculture. So 10 plus 6, 16 lakh. Is this clear to everyone? Yes. Next is income from growing and manufacturing of rubber. Rule 7A. This rule says that when the income is derived from the sale of latex rubbers which are there, right, which are manufactured or processed from rubber plants and then sold. In such case, 35% will be business income, 65% will be agricultural income and will be exempt. So let's say, for example, here these are sold in market for 36 lakhs. The cost of growing rubber plant is 16 lakh and the manufacturing of latex is 12 lakh. So here the 36 lakh is my sale, 16 lakh is the cost and 12 lakh is that of the manufacturing of cost of latex, which comes to 8 lakh. Now out of this 8 lakh, 65% will be agriculture, 35% will be business income. Next is rule 7B, which is income from growing and manufacturing of coffee. Again, same thing, sale of coffee grown and cured by the seller. 25% will be business income and 75% as agricultural and will be exempt. In case of the income derived from sale of coffee grown, cured and then roasted and grounded. What does that mean? See, coffee grown and cured, basically cleaned. Beans, sale of beans, it is 75-25. When the coffee is grown, cured, roasted to give that, particular flavor out and grounded in particles, right? Then you add, let's say, hazelnut flavor and all of that. In that particular case, 40% is business, 60% is agriculture. Clear? With respect to tea, it is 60% agriculture, 40% business. Are we clear? Any questions, any doubt? Yes? Next is, if you look at the last part of 2.1a, any income derived from any building owned and occupied by the receiver of the rent or the revenue of any such land, or occupied by the cultivator or the receiver of rent in kind of any land with respect to which or the produce of which any process mentioned in paragraph 2 and 3 of subclause B is carried on, provided that the building is on or in the immediate vicinity of the land and is a building which the receiver of the rent or the revenue of the cultivator or the receiver of rent in kind by reason of his connection with the land requires as a dwelling house or as a storehouse or other outbuilding. And the land is either assessed to land revenue in India or is subject to local rate assessed and collected by officers of the government as such, or where land is not so assessed to land revenue or subject to local rate, it is not situated in any area which is comprised within the jurisdiction of municipality or a cantonment board and which has a population of not less than 10,000, or in any area within the distance measured aerially, not being these kilometers and the population limits are to be satisfied. For the removal of doubts, it is hereby clarified that the revenue derived from land shall not include and shall deem never to have included any income arising from the transfer of any land referred to in item A or B of subclause 3 of clause 14 of this section. Basically, this will not include revenue derived from a rural agricultural land. 214 is what? Capital asset. Capital asset does not include rural agricultural land. So what they say is that the revenue derived from land will never include the revenue derived from a rural agricultural land. Then they say it is hereby declared that income derived from any building or land referred to in clause C arising from the use of such building or land for any purpose, including letting for residential purpose or for the business or profession, other than the agriculture falling under A or B, shall not be agricultural income. Now let us understand this one by one. So income from the farm building which is owned and occupied by the receiver of that rent, or revenue of any such land or occupied by the cultivator or the receiver of rent in kind of any land with respect to which, or the produce of which, or any process of such agricultural activities carried on that land would be treated as agricultural income. Are we getting this? So any income from that building, farm building, which is owned and occupied by that receiver, who is either tenant or who is owner, or is occupying as a cultivator, with respect to which he is growing the produce from that, or is carrying out any processes in relation to make that agricultural commodity sellable in the market, so then that will also be considered as the agricultural income. Are we clear? Any questions, any doubt? Now, the income, if it is in the nature of income from that use of such farm building, is for the purpose of letting for residential purpose or for the purpose of any business or profession, which is not in connection with growing the crops or making the crops sellable in the market by performing some process, that will not be agricultural income. So if the land is used for residential, if the land is used for business or purpose, business or profession, then it is not agricultural income. So the income from the farm would only be agricultural income if the building is in the vicinity of the land, vicinity of the agricultural land which is situated in India. The receiver of the rent or the revenue or the cultivator is having the connection with such land which require it as a dwelling house or a storehouse, basically where we are, like staying there to supervise the farm, or we are, storing the produce over there. That should be the basic function of that particular farm building. Right? And the land should be either assessed to the land revenue, and it should not be located within the jurisdiction of a municipality which has a population of not less than 10,000. So basically, it should not be urban agricultural land. So these are the limits that they have given. Right? So for example, the shortest aerial distance, it's not the kilometer distance, it's the aerial distance. The local limit municipality or cantonment board is less than equal to 2 kilometers. The population should be greater than 10,000. If it is greater than 2 kilometers, less than 6 kilometers, it should be more than 1 lakh. And greater than 6 kilometers, less than 8 kilometers, it should be 10 lakh. Right? So let's say, for example, if the aerial distance from the local limit of municipality is 1 kilometer and the population is 9,000, would it be an agricultural land?
Yes.
Yes, right? Because this is less than 2 kilometer. If it is 1.5 and 12,000, then no, right? If it is 2 kilometer and 11 lakh, obviously no. So both the conditions needs to be satisfied. 3 kilometer and 80,000. Yes. 4 kilometer and 3 lakh. Yes or no?
No.
No, madam.
No, right? 5 kilometer and 12 lakh? No. 6 kilometer and 8,000? Yes. 7 kilometer and 4 lakh? Yes. Because you're fitting within year.
Yes.
8 kilometer and 10 lakh 50? No. 9 kilometer and 15 lakh?
No.
Yes. Because this should be 11 kilometers. If it is 9 kilometer, there is no population limit. These limits are, if it is less than 8 kilometer, the population should be more than 10 lakh of that area. So it should not be situated in any area within this distance and in relation to this range of population. But if it is more than 9 kilometers from a municipality, there is no limit on the population. Are we getting it? So that
Yes,
will be an agricultural land. the logic is that the income arising from the transfer of agricultural land in the urban area is not an agricultural income. So income should be from the rural agricultural land, from the transfer of rural agricultural land. Income should be the agricultural income. So what is exempt is agricultural income, which is from the growing of crops. It could be nursery. It could be involving any process to make it a sellable item, but the process should be to make it sellable in the raw form. If you do any manufacturing, if you do any marketing, it will be partly agriculture, partly business. And income from renting out of that agriculture land. Income from renting out of urban, rural, any agriculture land is exempt. But income from the renting out or income from the farm building, which is building situated in vicinity of the agricultural land, can only be exempt if it is situated in the vicinity of rural agricultural land. If it is situated in the vicinity of urban agricultural land, it is not agricultural income. If it is sale of the agricultural land, it is not a capital asset provided it is a rural agricultural land. So sale of rural agricultural land is the agricultural income. It is not a capital asset. Sale of urban agricultural land is a capital asset. Are we clear? Any question, any doubt?
No, madam.
Okay.
Okay, ma'am.
Now, here any non-agricultural income does not become agriculture on account of some indirect connection with land. For example, a rural society as its principal business, the selling on behalf of its member societies, butter made by these societies from cream sold to them by the farmers. So making of butter is a separate process, which is separate from growing of the, or obtaining that cream. So butter resulting from factory operations separated from the farm is not the agricultural produce and society is not entitled to the exemption. For example, X was the managing agent of a company. He was entitled for a commission at the rate of 10% on the annual net profits of the company. A part of the company's income was agricultural income. So X also claimed that, whatever commission he is deriving from the sale of that particular or the net profits that he has generated for the company should also be agriculture. That is not possible. It's a very indirect, far-fetched nexus. For example, Y owned 100 acres of agriculture land, part of which is used for pasture for cows. Now the land was purely maintained for manuring and other purpose connected with agriculture, and only the surplus milk from the cow was sold. So the selling of the milk is not agriculture. Right? So, let's say for example, if a company is doing agricultural operations and then it generates the dividend, tomorrow you can't say that dividend is agricultural income because it is generated out of the profits of the agricultural company. No, that's a far-fetched connection. Now, in case of the growth of some, forestry, there are, some, ancillary trees which grows automatically on the soil, which does not require any human skill. Even if you don't feed them anything, they will grow. In our own pots, you will see sometimes there are some, trees which grow by themselves. So that is again not agricultural income because it grows spontaneously. It doesn't constitute agricultural income. There is no human skill and labor. There is no cultivation of the soil at all. Even though the operations in the nature of forestry operations are performed by the SSC, may have the effect of fostering the growth of such trees. But these are not agricultural income. So what is agricultural income? Income derived from sampling seedlings grown in nursery, growing of flowers, creepers, rent from the land, used for grazing of cattle required for agricultural activity, income from growing of bamboo. What is not agriculture is poultry farming, fishery, dairy farming, breeding of livestock. Are we clear? Yes or no?
Yes, ma'am.
Any doubt, any question? So see, if a person is receiving rent towards using of the agricultural land for shooting of a film, whether it is agricultural income?
No, ma'am.
It is not agricultural income, right? Now, next is the partial integration. So even though the agricultural income is exempt, right, subject to that it should be agricultural income. However, how we calculate or how we give the exemption is subject to the partial integration. What is partial integration? Basically, I will add the agricultural income to my total income. It's exempt. But to decide my tax slab, whether I'm fitting within 2.5, whether I'm fitting within 5 to 10, whether it is my above 10 lakh, to decide my tax slab, I will integrate the agricultural income in my total income. It is not getting taxed, mind it. I'm not taxing it. It is just to decide my slab rate. It shouldn't happen that if tomorrow I say I have only income up to 2.5 lakh, even though I have agricultural income of 1 CR. So if I have agricultural income of 1 CR, I can't be saying that I have only interest income or dividend income of 2.5 lakh and therefore I don't pay any tax. No, I will still be ending up paying tax because the slab which will be applicable to me will be about 10 lakhs on that 2.5 lakh income, even though my agricultural income will not be liable to any tax. So this is known as partial integration of agricultural income with non-agricultural income. And this is applicable to individual HUF, AOP, BOI to whom the slab rates are available under the Income Tax Act. What are the conditions? The agricultural income should be more than 5,000. If it is less than 5,000 per annum, partial integration does not apply. And my non-agricultural income should exceed the basic exemption limit. Right? So under 115 BA is the basic exemption. And under old regime 2.5 lakh. If the income is below basic exemption limit, then it's fine. Right? So the agricultural income more than 5,000, non-agricultural income should exceed the basic exemption limit. These provisions do not apply to company, LLP, firm, cooperative society, local authority, right? This only applies to individual HUF, AOP, B1. Now, tell me one thing, where is this given in the this partial integration scheme? Under which section does it come from? Anybody knows that? Yes. See, this comes from again the Finance Act. This entire scheme of partial integration again forms part of your Finance Act, students. Are we clear? So you will find this again in your Finance Act itself. This entire scheme of the partial integration. Okay? So every year, this particular scheme you will see in the Finance Act itself. This scheme of partial integration. Okay, students? Now, tell me one thing, how do you do this partial integration? So, to do this partial integration, what we need to do is, basically, first we have to see add the non-agricultural income with the agricultural income, net agriculture, after the expenses, of course. And you compute the tax on that entire amount. Then add the net agricultural income and the basic available to the assessor and compute the tax on that. And then deduct from the step 1, the step 2. And the step 4 will be the sum so arrived will be increased by surcharge, or you will give the rebate under 87A and add the cess. So let's say, for example, if I have income from salary of 11 lakh 50, house property 380, agriculture income from land in Assam 450, expenses incurred for earning agricultural income 160, and I have to compute the tax liability. Alright. Now let's say, for example, I am computing under 115 BAC. Now net agricultural income more than 5,000, non-agricultural income more than basic exemption limit. So I will first calculate everything This income from a house property, I will assume this is after all the standard deduction and all of that. Net agriculture income is 450 minus 160, which comes to 290. Now this is exempt. I will show this as exempt. Presentation is very important, students, in exam. This is less exempt under 10.1. Now I will have gross total income. There are no deductions and this is my total income. Step 1, calculate on this 15,30,000. Right? On this 15,30,000, I will add the agricultural income. I will first partially integrate the both. So 1530 plus 290 is my agricultural income. This comes to 1820. On this, I will calculate the tax, which comes to 1,64,000. Right? 4 lakh up 5%. Then again 10%, 15%, 20%. This comes to 1,64,000. Step 2 is I will calculate the tax on 2,90,000 plus the basic exemption limit of 4 lakh. On 6,90,000, I will calculate the tax. Comes to 14,500. Right? Now 1,64,000 minus 14,500 will be my final tax, which is 149,500. On this, I will add the surcharge, cess, rebate, whatever. Are we clear? Now, if let's say, for example, this person was 40 and 80 years old, they have given some age here, 40 and 75. So, if I am going as per the old scheme, then I will calculate using the basic exemption limit of 250. Okay. So, I will add 250 on 540. I will calculate the income. The difference between the two is my total tax. Are we getting it? If it's 75 years, then in that particular case, I will add 3 lakh rupees. Are you following this partial integration, students? Yes, or no? Okay.
Yes.
Fine. So this completes your agricultural income. Now, what are the other exemptions left? I'll quickly run through. These are self-explanatory and some of it we will be dealing in specific chapters also. So I'll not touch upon it much. Amount received by a member from the income of the HUF is exempt, right? So HUF, once it pays the tax, the members do not have to pay the tax in respect of any amounts received by them, right? So exemption applies only in respect of payment made by HUF to its member out of the income of HUF, right? So in that particular case, this is not taxable. Same as the share of income of a partner. So the share of profits from the partnership firm is not exempt. Again, we are going to look at it in detail in the assessment of various entity class for both, for the partnership firm as well as for the HUF. Right? So the partner's share from the firm will not be taxable. It will be exempt. Are we clear? So a partner, one issue which has arisen in respect of partnership profit which is there, that the amount which would be exempt in the hands of the partners of a partnership firm in cases where the firm has claimed the deduction under Chapter 6A. So whether it will also be exempt in the hands of the partner, again the answer is yes. So the CBDT has clarified that the income of firm is to be taxed in the hands of firm and it can claim any deduction if it wants. The entire profit, once it is credited to the partner's account, would be exempt in the hands of the partner even if the firm has not paid any tax on those profits. So if firm is claiming any, let's say, deduction under ATIA, ATIB, 10AA, whatever, and it distributes the income to the partner, that will not be taxed in the hands of partner. Irrespective of the firm pays tax or not, the partner's income from the firm, the partner's share of profit from the firm is exempt without any condition. It doesn't have any condition that it should be taxed in the hands of firm, only then the partner can claim exemption. Nothing like that. It just says the share of profit is exempt. Next is payment to Bhopal gas victims. Again, this is exempt. Compensation received on account of disaster. These are exempt. Okay. Then educational scholarships which are granted to meet the cost of education is exempt irrespective of the amount or source of scholarship. Payment to MPMLAs is exempt. Awards for literary, scientific and artistic artistic work by the government. If any awards are given, that are exempt. Pensions received by recipient of gallantry awards, Paramveer Chakra, Mahavir Chakra, those who receive and they receive the pension, that is exempt, even the family pension. Then former rulers annual value of their palaces which are there are exempt. These are preserved. Then income of local authorities like municipality, panchayat, cantonment board is exempt. Income of research association, scientific research association is exempt. Then you will see this income from of professional associations, right? So any kind of professional associations which are established having the object of medicine, accounting, regulating the engineering, or these are basically exempt, but these have to be notified by the government. Then armed forces, this is exempt. Then income of funds established for the welfare of employees, like any trust which are established for the PF, gratuity, these are exempt, right? Life insurance corporation, khadi village industries, these are exempt. Then you have income of authorities set up under the State of Provisional Act for promotion of khadi again. Income of the authorities to administer religious or charitable trust, like any authorities which are regulating gurdwaras or churches, these are exempt. IRDA is exempt. Central Electricity Regulatory Commission, Prasar Bharati Broadcasting Corporation, which is there, is exempt. Then these are certain funds like Prime Minister National Relief Fund, your Prime Minister's Fund, Clean Ganga Fund, Chief Minister Fund, or any universities financed by government, institutions financed by government. All of these have the exempt income, right? Income of mutual funds are also exempt, which are registered with SEBI. Income of the investor protection funds set up by the recognized stock exchanges are exempt. By the commodity stock exchanges are exempt. Income of investor protection funds set up by depositories are exempt. Okay. Then core settlement guarantee fund, which is again set up by recognized clearing corporation, is again exempt. Income of trade unions is exempt. Income of provident funds, superannuation fund, gratuity funds is exempt. ESIC fund is exempt. Members of the scheduled tribe, Sikkim, people from Sikkim which are there. Income of agricultural produce, APMC, which is their market committee. Income of the backward classes or any corporations for minority community, for upliftment of servicemen, for scheduled caste or tribes, these are all exempt, right? Then tea, coffee, rubber board, tea board subsidies, or any other subsidies which are given from international sporting event in India, any income arising therefrom, like BCCI or all of these would be receiving, right? Or in companies which are in the business of generation or transmission or distribution of power, right? So any grants which are received in relation to the generation or transmission or distribution of power by a subsidiary company from its Indian holding company, so in that particular case, this will be exempt. Local authorities, NPS trust, which is there, or certain notified entities which are not engaged in commercial activity, or any town planning authorities which are there, the credit trust companies which are there, infrastructure debt funds are there, or Indian Strategic Petroleum Reserves Limited is there. Then you have institution established for financing infrastructure and development, or financing institution which are licensed by the RBI. All of these are exempt income. Now what is important is there is a restriction on allowability of expenditure. So as per section 14A, it says expenditure incurred in relation to generating an exempt income will not be allowed as deduction. So basically, if you're not considering the income as exempt, the expenditure in connection to that exempt income should also not be allowed. Right? So basically, it says that the AO can then decide the amount of expenditure, because you can incur, let's say, salary, which could be partly for exempt income, partly for business income, right? But that salary is like a total salary paid. So AO will determine what is the amount of disallowance that should be there based on, like, how much disallowance I should make based on the income that is generated, which is exempt, and the non-exempt income. So there is rule 8D which provides a method for determining the disallowance of the expenditure in relation to the partly exempt, partly taxable income, right? So for that, the AO will look at the books of account, and in that particular case, the AO will then decide that what will be the expenditure will be disallowed. So it will be the aggregate of total expenditure incurred for the generating exempt income, or the amount equal to 1% of the annual average of monthly average of opening and closing balance of the value of investment, the income from which do not form part of the total income. Like let's say I have the capital asset which is generating some exempt income. So the value 1% of that value. Now this will be considered as my expenditure which shall be disallowed. Are we clear? Yes or no?
Yes, ma'am.
Okay. Any question, any doubt? And this is applicable even in case when you have not really earned any income during the year. Because the assessees were saying that we have not earned any income. So expenditure should not be disallowed. Doesn't matter. You were doing the activities which is resulting into generation of income. Even if you actually did not earn any income, the expenditure will still be disallowed. Are we clear? Yes or no? Okay.
Yes, ma'am.
There is one case law which says, is 14A applicable in respect of deductions? So 14A is applicable in respect of earning any exempt income. Deductions are given for the income included in total income. So 14A is not applicable for that. So disallowance will not be made for any deductions claimed under 14A. So with this, we complete this particular chapter. And if you have any questions, I'll be happy to discuss. Otherwise, we can close the session. Yes, any questions, any doubt? Fine. So we'll close the session. Thank you so much.
Yes, ma'am.
Ma'am,
Yes.
actually, we have to make an announcement.
Sure.
Yes. So students, actually, the DTBOS classes will be now now onwards will be on Tuesday and Thursday. Okay. And in sessions, we will take MCQs also for the previous sessions that we have learned. Okay. So if you are having any today, if you are having any time, then I will share my screen, and you have to scan the QR, and then you have to attend the MCQs. Okay.
Okay.
Okay. Ma'am, can we share the screen?
Yes.
Is it visible?
No.
Just a second. So, ma'am, I think I don't have any option to share the screen.
Okay. Actually, I think Ajit ji will be able to have, or Ashok ji.
एक्चुअली सर ये एक वेबसाइट है जिसका स्क्रीन मेरे को शेयर करना है मतलब आई हैव टू शेयर माय डेस्कटॉप जूम में हो सर एक्चुअली इसमें ऑप्शन आ नहीं रहा है नो सर
सर अनाउंसमेंट क्या था, एक बार ये वापस अनाउंस करेंगे?
एक्चुअली द क्लासेस will be now onwards will be on Tuesday and Thursday.
Only 2 days.
Yes. Okay, so can now you can see the screen. Yes. Is it? Okay. So students, now you can scan this QR and you can attend the MCQ. And I am also sharing this on chat.
So that we can access anytime, sir.
You can access anytime, but you can now scan and you can start the MCQ. If you are having a second phone or laptop,
Okay.
are you joining?
Not yet, sir.
Okay, I'm waiting for someone to join. Okay. So there will be a timer for each and every question, and you have to attend that question. and then after that the answer will be shown. Okay, we will go to the next question, and we will also having 1 minute time. Okay, the answer was the settling income through the trust deed, where income from property is directly given to a beneficiary before reaching the SSE. Okay, any doubt? So we will moving to the next question. We'll move to the next question, the last question for the day. Okay, so the answer was as per this is 4, which is 22% for the entire 65 lakh. Okay, at this with this we will end today's MCQ session. But and the winner, which means who has got the most right answer, was Tambar Mishra, and the second will be Miruna, and third will be Chitra. Okay, so you can see that the result also. We will do this interactive session for every day, whatever the session will be, and for the previous days, whatever you have read, it will be asked in the next session. Okay. Now we can conclude the class. Okay, ma'am?
Sure.
Okay. Yes? Okay, okay, over.